Quality. That's what this channel represents. Quality research, quality analysis, quality businesses. To put our hard-earned money in anything less is to fail. Our investment strategy insists on only buying the best of the best. But what if something claims itself as quality, but is not? A wolf in sheep's clothing, if you will. Just as important as identifying quality is identifying false quality, a business in decline. And sometimes a world-class brand is just a veneer for a business in decline. Welcome to the Quality Investor. What has happened to Nike? At the midpoint of 2024, this mega brand's share price has fallen a staggering 29% year to date. And from its all-time high of $172.49, it's declined a morbid 56%. The bulk of the drop year to date came from just yesterday, as the stock, ticker NKE, dropped 20% on the back of a very disappointing earnings to close out its fiscal year 2024. Perhaps this decline is now an opportunity. Perhaps we can now buy a great business at a fair price. On today's video, I want to dive into this earnings and tease out if Nike is an undervalued giant or a business in decline. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Nike was a small and struggling running shoe company in the early 1980s. That all changed in 1984, however. Nike signed the one man who would go on to become one of the most famous people on earth in my lifetime. Throughout the 1990s, this man inspired a generation of youth, me included. He catapulted Nike to dizzying heights. This man was Michael Jordan. His trademark shoe, the Air Jordans, became the best-selling shoe of all time. Everyone wanted to be like Mike, and Nike became synonymous with athletic excellence. Nike built a sportswear empire, and it only attracted the top athletes in the world as brand partners. Nike had this knack for identifying talent before they became the greatest ever in their sport. In 1994, they signed Roger Federer. He was only 13 years old. And then in 1996, Nike struck gold again. Nike signed Tiger Woods, and their ascent to the top of the golf world began. All three of these athletes have reported earnings of over $1 billion in their lifetime. Nike's empire was so vast and powerful that it brushed off protests in the late 90s around its labor practices. They continued signing the best of the best into the 2000s. Names like Kobe Bryant, LeBron James, and Derek Jeter. Nike had solidified itself as the premium brand in athletics. Its marketing was unmatched. They became the official suppliers of the NBA, NFL, and FIFA World Cup. In 2013, Nike joined the ultra-exclusive Dow Jones Industrial, a collection of 30 of the bluest blue-chip stocks in America. Nike was now a part of American capitalist royalty. Nike reached its all-time high of $172.49 on November 5th, 2021, and like I mentioned earlier, has declined 56%. So what has happened? Why did this iconic brand fall so hard? This is a brand associated with premium quality and excellence. It seems to be a combination of factors. Up until about 2021, Nike was remarkably consistent. In revenue, earnings, and free cash flow, Nike seemed to grow like clockwork. But after 2021, that growth has started slowing a bit. We can see that the free cash flow here rebounded after 2020, the COVID year, but has been up and down since. The other thing I find concerning is their stock-based compensation. You can see as a percent of free cash flow that stock-based comp has risen. Before 2020, it was consistently below 10%, but is now creeping up above 10% each year. Increasing stock-based compensation has a dilutive effect on shareholders. You can see here that their margins are falling as well. Typically, their operating margin is between about 13 and 14%, but it has declined a little bit in the last couple of years. You can see that up here as well. You can see that the 10-year average for their operating margin is at 12.75%, but it has come down to 11.5% in the last year. That may not seem like a lot, but a 1 to 2% difference can mean as much as $1 billion in additional costs for Nike. But it's the why behind the margin decline that's so concerning. Nike has always dealt with counterfeiting of its products. In fact, it's the reason they ended their partnership with Amazon in 2019. But theft has become a major issue at its stores. It has gotten so bad that it's prompted store closures across the US. In 2018, Nike's store count peaked worldwide at 1,182. It is now down to 1,032, a closure of 150 stores. This includes their flagship store in Portland, Oregon, just miles away from their headquarters. Theft eats into margins in various ways. Aside from writing off actual inventory, there's added costs of security measures, both equipment and labor. And if customers don't feel safe in stores, they're simply not going to go in and shop there. That is lost revenue. And that direct-to-consumer revenue is a core focus of Nike. I mentioned their affiliation with Amazon. That partnership failed, and this article here points out some reasons. This article from Forbes is entitled, "Why Nike Cut Ties with Amazon and What It Means for Other Retailers." Up until 2017, the only Nike products sold on Amazon were either counterfeit or gray market items. Gray market goods are manufactured by the brand, unlike counterfeit products, but sold through unofficial channels. In this case, gray market channels refer to independent third-party vendors who sold unlicensed Nike products directly on Amazon. The goal behind this deal was to cut back on unlicensed, unauthorized sales, but by eliminating third-party sellers, Nike had also hoped to redirect sales to their own channel. This, of course, would allow them to collect more customer data and leverage Amazon's gigantic retail scale. What went wrong? In what can be considered the Wild West of retail, the gray area market is virtually unregulated, and third-party sellers are nearly impossible to eliminate. Once banned, unsanctioned listings simply reappeared under different names. And because official Nike listings failed to garner more reviews than popular gray market ones, the official products were harder to discover. Coming over to this article, Why Nike Left Amazon and Why It Was Smart. So what they're saying is it's a very bad deal for Nike. Counterfeit products would still appear above actual Nike shoes in searches. The real winner was probably Jeff Bezos. Amazon got a commission from every sale that Nike made on the platform. But that wasn't even the worst part of this deal. Remember how one of the reasons why Nike wanted to do this was to collect customer data? Well, Amazon got that valuable data from Nike customers, which Amazon has used to hurt companies who sold their products on the platform in the past. To me, the Air Jordans are like the iPhone of shoes. A person's going to buy the Air Jordan. They're not going to buy something that looks like an Air Jordan. But Nike still didn't want to deal with that headache. So I mentioned that direct-to-consumer revenue was part of Nike's core focus. Well, it seems that was part of the reason for leaving Amazon. Seems Nike's strategy is working. According to Bloomberg, about 68% of Nike's annual sales came from wholesale channels, down from 81% in 2013. Those numbers show that Nike isn't selling as many products as it used to through partners. That means the company is sharing less of the money and its data with Jeff Bezos of the world. I think this is also contributing to the stores being shut down. Aside from theft, which is a real problem, they're pushing more and more sales to online through their app. That certainly cuts down the amount of theft raids that have been hitting Nike stores. Nike's made some other missteps as well. Having a great brand doesn't mean that every move that you're going to make is automatically successful. Nike has made moves in the digital space that haven't worked out. Back in 2013, the company released the Fuel Band, a wearable device that was meant to count your calories, kind of like an Apple Watch. It was discontinued after just 3 years. Nike is, after all, a shoe company, not a technology company. But you know what they say, if you can't beat them, join them. Apple has since partnered with Apple to offer Nike-branded bands for the Apple Watch. Nike is also facing increasing competition. Other premium brands have entered the market the last few years, and they're chipping away at Nike's market share. While Nike still boasts the top market share in the world, between 30 to 40% depending on the source that you look at, this chart shows the newer upstart brands such as Lululemon, On Running, and Hoka eating away at the legacy brands such as Nike and Adidas. You can see that market share of the legacy at 80% in 2013 and has since declined to 64% last year. To me, this seems like a market where premium sportswear is not only in a status battle, but is becoming commoditized. You see, when goods become commodities, they have to compete on price. And because of that price competition, the sportswear giant is also tweaking its product lineup to roll out new 100 and under sneakers in countries around the world to appeal to price-conscious consumers. This came from the earnings release, where Nike also announced guidance for 2025 that really frustrated Wall Street. The company on Thursday projected a mid-single-digit percentage fall in fiscal 2025 revenue, compared with analyst estimates of a near 1% rise. That, of course, is the main reason for the 20% drop we saw in share price on Friday. Wall Street hates guidance that is either below their expectations or is lowered, and Wall Street punished Nike harshly. So with all this negative sentiment that I just talked about and in their earnings release, the question becomes, is Nike really in decline? Or have they entered into undervalued territory? And perhaps like Starbucks, once they get back on track, they'll explode again. Well, like I mentioned earlier, this earnings report was disappointing, not just for the guidance, but in the actual numbers as well. Full year revenues were only up 1%. And for the year-over-year quarterly numbers, they're actually down 2%. And it's even worse for the Nike direct revenues, that direct-to-consumer revenue. For the fourth quarter, it was $5.1 billion, down 8% year over year. Contrast that with their wholesale revenues, which are up 5% year over year. It seems like that strategy might be shifting a bit. In a statement from the CEO in this earnings release, John Donahoe says, "I'm confident that our teams are lining up our competitive advantages to create greater impact for our business." Now, that's of course typical CEO speak. However, what did catch my attention was the competitive advantages. And for me, that's where I see Nike starting to lose ground a little bit. What exactly is their competitive advantage now? Brands like Lululemon are exploding, and they're serving that premium market cohort just like Nike. Lululemon's not competing on footwear, however. That, of course, is Nike's bread and butter still. But to me, what that means is we should see Nike get back to that core. Go back to that core of their footwear and continue serving the athlete through performance innovation. Nike still has a massive competitive edge when it comes to the footwear business. But like I mentioned before, with other competitors such as Haka and On Holdings, it does seem that that whole entire market is becoming not just saturated, but commoditized. So from an investment perspective, what I'm really saying here is I just don't see where that economic moat really is for Nike. I don't think Nike's going anywhere. But at the same time, I don't think Nike has this unbreachable economic moat that's going to stave off competition for the next 10 to 15 years. Nike could very well just be an average returner over that time frame. And on that point, what is my actual projections now for Nike's share price? You can see the 5-year compound annual growth rate for their total revenue is at 5.6%. On my base case, I'm using basically analyst projections, and that's over the next 10 years at about 4%. A bull case would see them at about 5.5%, and a bear case would only see about 2.2% revenue growth over the next 10 years. And I'm projecting a year one decline of 6.5% in revenue for Nike based on what the forward guidance was for 2025. So where does this bring us here? So from the base case, I have an operating margin percentage here by year 10 of 12.25%. That's roughly in line with what their most recent trailing 12 operating margin is, and a bull case operating margin of 13.5%. For net margin by year 10, I have it at 10% for the base case and 11.3% on a bull case. And for free cash flow margin, I have it at just over 10.75% for the base case and at 13% for my bull case. And with that increasing competition, and margins getting squeezed by theft, it's going to be tough for Nike to really expand on that free cash flow margin over the next 10 years, which is of course what drives share price, at least in the long term. So Nike fell to $75.37 on Friday. That brought its PE ratio down to 20. That's pretty far below their 5 and 10 year average, which hovers around 35 to 40. Their forward PE is at 28.5, given that they're expected to have a pretty steep decline in revenues next year. Again, well below their 5 and 10 year average. Based on my discounted cash flow analysis, my bear price for Nike has come out to $56.45, $77.43 for the base case, and $103.40 on a bull case. Nike does pay a pretty nice dividend, however. It yields at just under 2% and has increased in the last 10 years by about 11 to 12% every single year. My dividend discount with about a 10.5% increase annually for the bear case, 11.5% increase for the base case, and a 12.5% increase annually for the bull case. We're at $60.75 for the bear, $74.13 for the base case, and a $94.23 on a bull case. And for my exit multiple price, I have $78.14 using the comps of Deckers Outdoor, Skechers USA, Crocs, and Lululemon Athletica. So without any margin of safety for Nike, we have a buy price of $77.83 and a forward PE of 29.4. So that current trading price is $75.37. It's below that buy price, but that's without a margin of safety. And with a business like Nike, I want at least a 20% margin of safety, maybe even 30%. And like I said, that's due to that increased competition, the general retail theft issues that they're having, and the commoditization of their products. To me, Nike doesn't differentiate themselves anymore like they used to. So with a 20% margin of safety at least, we have a buy price of $62.26. with a forward PE of 23.5, and at a 30% margin of safety, that's a $54.48 buy price with a forward PE of 20.6. So it's too early to tell what Nike's price is going to do, but if they have another bad earnings report, it's very well that price can come down again. But for me personally, I'm going to be staying away from Nike. I just don't see what their economic mode is. I don't think they're going anywhere, but I just can't see them being a strong growth company in the foreseeable future. I view them a lot like Coca-Cola, a world-class, instantly recognizable brand, but a company that's just not going to grow like we want to see here on The Quality Investor. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.